Hello. In this video, we're going to talk a little bit about long-term liquidity ratios. In a separate video, we talk about short-term liquidity ratios, so obviously there's some relationship there. With a long-term liquidity ratio, you're asking a question over the long term, over the life of the company, based on what it has on its balance sheet right now. How well would it be able to meet its long-term debt and other liability obligations? And so generally this is somehow related to being able to use um, assets on the balance sheet to pay off debts, those sorts of things. It's probably most relevant to long-term debt holders and maybe to new lenders who, let's say the firm has gone out and is trying to borrow more money, and so those lenders are trying to assess before they make a long-term loan whether or not the company can even pay off the loans that it already has. And even sometimes they'll do sort of modified long-term liquidity ratios at that point where they'll say, okay, now let's add the debt that they're asking for from us and see if they could still pay everything off. These are also, many of them sometimes referred to as leverage ratios. Leverage is a financial concept that speaks to how much of your firm is funded by debt rather than equity. And so obviously most of these are tied to the amount of debt that you have. So the simple debt ratios, there's a handful of these. There's debt to assets, debt to equity, assets to equity, which is basically one over debt to equity or one plus debt to equity. And I'll leave it to you to do the proof on that. That's just sort of an accounting identity. But you can see you got debt, you got one plus debt. So it really is either debt to assets or debt to equity is what you wind up with. Obviously, the amount of debt that the company holds increases the interest it has to pay. It increases the principal it will eventually have to pay. Both of those are bad things. But it also increases the return to equity holders. The way it does that is, think about it. At the end of the day, let's say that, assuming that the cost of debt is lower than the cost of equity, let's just say that I can borrow debt at 5% interest and use it to invest in a project that earns 20% a year. So 5 of it goes to pay off the interest payment. The other 15 goes to the equity holders. And they didn't have to put up any extra money to get that 15%. So it's like getting that return without having to invest anything extra. If you're starting out a company, think of it as that, let's say you need $1 million. Well, and in return for that, let's say every year you're going to earn $100,000. So 10% a year, right? 100,000 to $1 million. Well, if you were to finance that 100% with equity, then the equity is going to get 10% a year, right? 10% return. But what if I finance it with half debt and half equity, and the debt only costs me, 5%, and so I'm going to get $500,000 worth of debt. It's going to cost me 5%, so that's $25,000. Okay, so that's going to leave me out of my 100,000. It's going to leave me with 75,000. It's actually going to leave me with more than that because the interest on debt is tax deductible. So if we said that you get a third of a tax credit there, then that 25% or 25,000 really goes down to about 16,000. And so I'm left with about $85,000 there. So I get 85,000 back, but the equity holders only had to put in 500,000, and so now they're getting like 18% on their money, 19%. So from their standpoint, I guess it's 16%. They went from getting 10% to getting 16%. And so they're doing a lot better. So firms generally like to have their equity holders like them to have some debt, and in fact, most firms sort of target debt that large firms target debt that's somewhere between 50-50 debt and 75-25 debt. You don't really want to go over 75-25 in a lot of companies, simply because then the interest starts to get expensive and the risk that you could default gets too high. But even those ranges vary from industry to industry. And so there are some industries that 50% debt would just seem too high, and others where it seems way too low. So if you wanted to affect these ratios, if you wanted to go up, then you increase borrowing and repurchase stock. So since they are tied, it's kind of debt and equity. If you increase the debt or you decrease the equity, either one of those is going to drive them down. Now, important thing on debt ratios, these are not done on market value. They're done on book value. So they're done on the dollars that the company raised from debt and the dollars that they raised on equity, or the amount that they owe on debt, let's say, and the amount that they raised on equity. So not market driven. If you felt like you had too high a debt ratio and you needed to lower it, let's say that your lenders say you've got to lower your debt ratio, then you could issue more stock, you could repurchase debt. So literally in that order, you could go sell stock and use that money to buy back some of the debt out in the marketplace, and that would lower your ratio. Then there's the cash coverage ratio, and cash isn't exactly the best term here, but it kind of the coverage is really what you want to focus on. It takes earnings before interest and taxes. So not the final profits and not cash profits, but it takes earnings before interest and taxes divided by interest. And so what you're hoping for is that, generally speaking, since once you get down to earnings before interest and taxes, all you have left is, so from that I need to pay the interest, and then if there's profits, I have to pay taxes on that. So that's good. And so you want your EBIT to be higher than your interest. And so therefore this ratio should be greater than 1. And being greater than 1 means that your earnings are high enough to cover your interest charges. And so that's a good thing. It does seem like sort of a short-term measure, but it's really not, because it's talking about sort of what's going on long-term with your earnings. You could assess this now, or you could assess it with sort of forecasts related to what you think is going to happen with earnings. Interest is contractual, so you have a pretty good idea with that. But it's an important ratio to keep track of, particularly when you're developing a business concept. If it's going to take a few years for it to get going, then your creditors are going to want to see that you have some sort of an interest coverage, even in the short term, or they're going to be a little bit nervous. Last thing they really want to happen is that you're using the money they borrowed to pay the interest, because then where's the money to pay the principal later on? So if you really wanted to do cash, again, if you remember, this is one cash coverage. This is another cash coverage that is sort of a modified version. Probably makes a little bit more sense, and that's what I would argue. And the logic for that, it's EBITDA over interest, so earnings before interest, tax, depreciation, amortization. The logic is, depreciation, amortization, yeah. The logic is that depreciation and amortization are non-cash expenses. Yes, on your income statement they get deducted, but you don't actually pay money out of your pocket for them. So technically, those amounts are also available to pay interest if you need them. Now, in the long term, I think people would take a view that basically says, but wait a minute, those are reflecting the decreasing value of your assets, and if you don't think in terms of then having capital spending that sort of replenishes those assets, then you're eventually just consuming the assets of the company to pay back the interest. And so that's kind of the tension between these two. But if you were really just focused, let's say over the next few years, on whether or not you had enough cash coming from your day-to-day operations to cover interest, this is actually the better measure. It, again, should be significantly greater than 1. Obviously, since you're adding more money into the numerator, if this is barely 1, that means that the EBIT over interest is not 1 at all, unless you just have no depreciation. And so this might be more relevant. Management implication here, obviously, you need to reduce interest charges. Clearly, you could say, well, what we need to do is raise earnings. But if a company, we're just going to work on the assumption that a company will always raise earnings if it has the opportunity to do so. So the management decision here would be to reduce interest charges. Remember, reducing interest charges can happen a couple of different ways. One is you cut down the amount of debt you have, but you can also reduce interest charges by going back and renegotiating terms and so forth to lower the interest rate on your debt. And that's really it as it relates to long-term liquidity. Again, not anything too difficult.